Okay, now it gives me great pleasure. Our next speaker before the break here is Mr. Andy Nadler, an agricultural meteorologist with Peak Hydromet Solutions. And Andy is well known to this group at the Manitoba Agronomists Conference. He's spoke several times in the past, been one of our go-to people. Yeah, we sheltered him in this nest of Manitoba agriculture for a few years, and now he's flown. I see you're based in British Columbia now, but wanting to bring us up to date with another option. And your title, Compliments of Tammy Jones, is Risky Business. Is Parametric Insurance the answer? So Andy, I'd invite you to take the podium.
All right. Well, thanks, John. Thanks, John and Tammy, for the invite. Appreciate being able to come and share. Yeah, as John mentioned, I spent many of my formative years in Manitoba. I grew up in Manitoba, spent about almost 10 years working with Manitoba agriculture. And then a few years ago, about 6 years ago, I moved to Vancouver Island. And some people ask me why. Not that many people, but a few people ask me why I moved. And I guess maybe half jokingly, I reply and say that, being a climate specialist and living in Manitoba, it's sort of, maybe it says something about the credibility living in maybe one of the most severe extreme climates in the world. So I came out to greener pastures, out to Vancouver Island, with the paradise and the nice weather. But what's interesting, you see in my presentation, here's a picture of Sumas Prairie a couple of weeks ago near Abbotsford with the flooding. That was following, I think, 2 or 3 atmospheric rivers that came through. Vancouver had its first tornado in about 50 or 70 years. In November, we had the heat domes and the fires this summer. So, paradise climate-wise, maybe it's not so much. So, who knows? Maybe I'll be running back to Manitoba soon for the lovely weather. But anyway, getting into this. It's quite timely. I've spent a lot of time recently looking at parametric insurance. Being a weather guy, I've mostly been focusing on the on the parameter side of it, which I'll talk about. But I think it's definitely timely, and it's definitely a good topic to go with the risk management side. So, given that we're talking about insurance, there's a few terms that I need to get into, and I think these are pretty important going through. Now, the first one is adverse selection. Now, in insurance terms, basically, it's typically when with insurance, the customer has the advantage of knowing more about their own risk than the insurer. So basically, the insurer doesn't know a lot about you. But the customer knows more about their actual risks, the activities that cause risk. So, you take the car, the insurance company doesn't really know how you drive. Say with health insurance, they may assume you're healthy and exercising, but really maybe you're not. Another term is moral hazard. Now, moral hazard is when the insured engages in risky behavior, knowing that they're protected and that someone else will absorb the cost. So knowing that I have insurance, well, maybe I'll be a little bit more risky. I like the rental car joke because, if you got the insurance, it's, who cares? So it's one of those things that when you look at insurance, things like adverse selection, moral hazard, they really skew the odds in terms of getting effective insurance coverage. Essentially, insurance should not encourage nor reward loss. So looking at this case, the tooth fairy, you don't want insurance to be promoting risky behavior, which can sometimes happen. That would be moral hazard. Now, another term you've probably all heard of is basis risk. That's one of those key terms in insurance. Now, in an ideal world with insurance, losses would be covered by insurance payouts. You have a disaster, you get paid out, and you're back to where you were. However, there's sometimes a gap between the actual losses and payouts, and this gap is termed basis risk. Now, if losses are incurred without any sort of payout, there's a negative basis risk. And if there's a payout without the policyholder having experienced any appreciable loss, then there's a positive basis risk. Now, in either case, this is ineffective. And where basis risk occurs, it's really an undermine of trust and confidence in the program. Basis risk has been found to have a negative effect on producers' willingness to purchase agricultural insurance. So if it's not working very well, why purchase it? And really, insurers must always strike a balance between the perfect match of loss versus payout. So if we look at the table here, if there's a positive basis risk, well, really the client is potentially paying too much for their insurance and not getting enough benefit. If there's a negative basis risk, well, the client is paid too little. The insurance company does okay, but it's not going to be very sustainable. So really that perfect match between loss and payout is really what's strived for as much as possible. Of course, it's not going to be perfect, but it should somewhat equal out. Now, what are the causes of basis risk in crop insurance? Well, as I talked about, adverse selection is one. There's the lack of historical data could be one. Maybe the yield data for the area is not very good. Maybe the climatic data is not very good, or with changing climate, well, some of those normals are less applicable now. Less than optimal management practices, that's another one. If the practices aren't as good as they could be, then that's another cause of adverse selection. And the other one is moral hazard. Are there risky management practices occurring? So if we look at conventional crop insurance, and this is what everybody's used to, there's sort of a train of processes that take place. An event occurs, the insured assess the damages, they submit the claim, they review the claim, adjuster assesses, validates the claim, then a claim is paid out. Now, this is a bit of a long process at times. So there's a few disadvantages to it. One of them is the cost of loss adjustment could be high, particularly in large areas, low income regions where there's not enough money to go around. Developing countries, this is really an issue. At times there can be slow payout. If there's if the claim and the adjustment isn't right, there's a process to go, and this can slow things down. Now that's at a time when, if things are going bad, the funds could be used right away. So that delay is definitely not a good thing. Loss adjustment can be subjective, depending who your the adjuster is. There could be some difference there. It's difficult to underwrite without historical data. Of course, Manitoba has pretty good historical data within its crop insurance archive, but in different areas, again, developing countries, there may be no yield data. So how do you underwrite an insurance policy if you don't have any historical data? So that's always an issue. Then there's moral hazard, adverse selection, basis risk, like I just talked about. Policies can be complex and ambiguous. If you've ever tried reading any of your insurance policies, well, good for you. And the other thing is it's quite difficult to cover non-financial losses. So it's one thing to look at direct yield losses, but what about non-financial losses like business interruption, reputation, those types of things? So those are things that they're much more difficult to insure. And the other thing is there is a great deal of loss that does remain uninsured. Globally, there's a huge gap between insured and non-insured. So there's a lot of data like this, various sources. If we look at the world natural catastrophes and overall insured losses from 1980 to a couple of years ago, we see a gradual increase. But what I want to focus on here is the amount of insured versus uninsured loss. So for 2020, about 30% of the losses were actually insured. So 71% were non-insured. So it's a massive amount that's just not insured. It's not covered. So these are losses that are causing real hardship. So yeah, globally about 30%. In middle to low income countries, only about 10% of these losses are insured. So there's definitely a big gap in terms of what the loss is and what the insurance is. So I want to talk about parametric insurance here now. Now, parametric insurance can be simply described as coverage that's based on a specific parameter and whether that parameter reaches or exceeds a certain pre-agreed upon threshold. Now, if the threshold's met, the policy gets paid regardless of the actual damage that occurred. And the payment scale is based on measurable elements that are correlated with the actual loss. So the amount paid out is determined by the severity of the event or by the triggering of an index. So what does that mean? Well, say for forage production insurance, if it's based on rainfall, we know the normal rainfall for the area, say it's 100 millimeters. If during that period the actual rainfall is below a threshold, say if the threshold's 60% of normal, automatic payout. If it's 50% of normal, well, the payout's higher, and it's scaled that way. So it's extremely simple in the sense where there's no adjustment, there's no proof of loss. It's just a very simple transaction. Now, something like forage production with grazing, it makes sense because it's very hard to determine yield when you're not removing grain that can be monitored, bales, tons, that type of thing. So it really works that way. Now, the indices, they could be episodic, could be hail, hurricane, tornadoes, floods, or they could be cumulative thresholds, things like rainfall deficits, excess moisture over a period, heat unit shortfalls, accumulation of heat stress. And really a trigger can be any metric that represents the occurrence or the severity of that abnormal event that results in loss. So basically the probability of these threshold levels are reflected in the premiums. The higher the probability, the higher the premium. And there's often no claim filing, no loss investigation, or a need for insurance adjusters. So it's very efficient in that way. The other thing too is with parametric insurance, both the insured and the insured have access to the same information about the likelihood of that event occurring. I'm going to explain that in a little bit, but the same information that is pretty important. Now, a couple of different examples of parametric insurance in agriculture. Now, if we look at the peril, for instance, if it's a corn heat unit policy, the parameter is how many corn heat units occur during the growing season. So that's just measured at a regular weather station. And depending on the policy, if it's say less than 95 or 90% of normal corn heat units, a payment's triggered. Forage production, I gave the example a second ago. If the growing season rainfall is less than a certain parameter, say 60 or 80%, the payment's triggered. There's some new technologies I'll also talk about, some of the satellite-based methods. Same thing, if it detects less than a certain normal parameter, then there's a payment. And another one I'll talk about, the canola heat blast, basically looking at critical heat degree days during flowering to look at heat blast causing yield loss, and it's basically days with the CHDD occurring. Now, as I mentioned, I focus a lot on those parameters, basically what goes into those into the parametric insurance policies, because those are pretty important. A lot of the time they're considered the source of truth. If the parameter is wrong, well, then everything that's based on it is in jeopardy. So there's a few criteria for parameters. Now, one of them is, well, it must be trustworthy. It has to be objective and it has to be independently verifiable. So if it's a farmer's rain gauge saying that, well, I measured, half an inch of rain, that's not really necessarily trustworthy, objective, or independently verifiable. If it's an official weather station, well, that's a little bit different. But the big thing is neither the insured nor the insurer can influence that event or its reporting. So really, a third party is ideal for reporting that parameter. Should be relatively easy to monitor and reliable. Ideally reported quickly. Must have some history associated for underwriting premiums and payouts, knowing what the risk is. And it must be quantifiable and highly correlated with what it intends to insure. That's why rainfall a lot of the time is used for agriculture, because we know, particularly in our rainfall reliant areas, non-irrigated, if there's less rain, chances are that's going to hit the yield. Now you notice on the image I have, it's a plot from a seismograph. Now, really that's probably one of your ideal types of parameters, and a lot of insurance policies and a lot of the early parametric insurance was based on earthquake insurance. They call it a shake and pay. So basically, if there's some seismographic activity above a certain Richter scale, it will be an automatic payout regardless of the damage. Now, if we look at those parameters and some of the factors, we figure, well, it works pretty good. It's difficult to influence. I don't know how to influence the values on a seismograph. They're just there. They record what's going on. So they're unbiased. They're reported by third parties, US Geological Survey, Natural Resources Canada. They have excellent historical records. They probably go back over 100 years of knowing what the likelihood of earthquakes is, and it's highly quantifiable. There's a scale that provides basically what the magnitude is. So if we look at a parameter, the perfect parametric insurance, not that it applies to the prairies, but as an example, that type of parameter is really ideal. So if we look at sources of the parametric data for agriculture, questions are, well, does that parameter represent my location? If not, then potentially there's some spatial basis risk. The other question is it correlated with my loss? If not, well, that brings about new type of basis risk called variable basis risk. So there's a lot of different types of risk in there. So let's look at an example. So if I'm insuring my field, doesn't matter what it is. Maybe it's corn. I'm looking at heat units. Maybe it's a forage field. Maybe it's canola.
Brian, one has some questions on his results. Okay. Thank you.
Sure, I'm hearing voices, but anyway, if we look at so the insured field, if it's going on a weather station, the first question is, well, how far away is that weather station? Is it a few kilometers? Does it really represent my field? Is it 30 kilometers away? Well, then there may be some problems. Maybe what's going on at the station and at my field are not that much the same. So that would be a spatial basis risk issue there. Now, there's ways to look at that. Certainly weather stations, there's networks that can be put in beyond the Environment Canada. So that definitely is an option. Another option is gridded data sets. I'll talk about those in a second, but essentially using models, reanalysis models that use factors like weather stations, radar, satellite, that type of thing to provide an estimate pretty much anywhere of what's going on the ground. So instead of using a nearby weather station, it's a grid that says if this field is, say, mostly within this grid or partly within these 4 grids, this is going to be the outcome of temperature, rainfall, that type of thing. Or there's also satellite, and I'll talk about that as well. So there's a few options. Now, if we look at the weather station side, well, there's those official Environment Canada weather stations. They're good quality. There's excellent history for a lot of them. The problem is there's just not enough of them around. That's where you do get that spatial basis risk, because chances are a lot of farms are not that close to the weather station. There's other weather stations. For instance, in Manitoba, there's the Manitoba Ag Weather Network, a network I know well from my days at Manitoba Agriculture. Excellent quality data. There's some history. It's getting more and more. It's better coverage. It's really good coverage across the province. And then other provinces have it too. Saskatchewan runs a weather network for crop insurance. Alberta has a really good weather network. So there are a lot of weather stations, good quality weather stations around. Then there's the on-farm type weather stations. Some are good quality, some are not such good quality. Sighting's an issue. If it's on a barn roof, it's not going to be as good. There's good coverage, but again, is it objective? If I'm a farmer that's operating my own weather station for insurance, are the optics very good there? So a few things to think about, definitely. The gridded data sets, as I mentioned, well, they could be good, but there's a little bit of homework to be done. I've spent a lot of time in analyzing, basically comparing some of these gridded data sets to actual weather stations, to high quality weather observations, and found different results. I think one thing is that the temperature seems to line up pretty good, really good correlation, but with rainfall, it's a little bit more scattered. Now, this could be just the variation in rainfall, which is very normal, particularly within grid cells, but also things like just knowing what model works best in each area. So that's really important for anybody to look at. So while the models are useful and they can be used anywhere, which is a real benefit, it's important to figure out which model works in which area. And then finally, satellite data. This is one area that's really, I would say, it's been around for a long time, things like NDVI, but there's some new products that are emerging for satellite soil moisture. So instead of having to use rainfall as a proxy for how much water is available to the crop, some of the satellites are now able to measure exactly, well, not exactly, but they're able to estimate what's in the soil for soil moisture. So that's really what the crop cares about. Some of the products, there's companies like Vandersat, Copernicus, some really interesting products. And you can see from the plot, you can actually see temporarily throughout the growing season, multiple growing seasons, what's going on. So there's good historical record. Now I want to jump into an example, and I find this really interesting, and this is just one of the many available parametric products that are out there. This one happens to be in Europe. There's a lot of products offered around the world. I'll talk about some of the local ones in a minute, but I just wanted to walk through this to show a couple of things. A, just how simple it is, and B, some of the value you can get out of these types of programs. So this one's a company called Meterologist. It's out of the Ukraine. And so what I'll do, these are just screen captures. I'm not going to go live because that's too scary. But what I've done is I've just selected some of the, basically, here's a policy that you could grab. So I'm going to go soil moisture. This is a satellite-based one. So I've selected, low soil moisture as my peril. Then I click through and I choose the layer of soil I want to use. And this is dependent on the satellite product. But if I'm doing say an annual crop, I'm going to look at my root zone. So say 28 to 100 centimeters. I click that, go through. I'm going to set my time frame. So in this case, I'm going to set for 2022. So this coming year, I want to ensure from May 1 to July 31st. So I hit confirm period. I'm going to select my location. I've zoomed right in here, but I would select a location of a field anywhere geographically. This one again happens to be somewhere in Eastern Europe, but depending on the policy. Now this is, in my opinion, this is really the exciting part. I've spent, the better part of 20 years as an agri-meteorologist working on risk management products in climatic indices, that type of thing. And I look at this and I hope other people appreciate this too, but I just want to stop and show you how useful this information is. So what we're looking at here is basically some different options. So basically I could cover the 20% of worst cases, the 15% of worst cases, or the 10% of worst cases. So if I translate this is euros per hectare. It's about 1184 per acre for this mid-grade type coverage. I can go lower or I can go higher. So cover the 20 or the 10. So it gives you my trigger. So I mentioned triggers before. If my soil moisture is below 29.8%, automatic trigger. And then the payment scale is an additional $13, so Canadian dollars per hectare for each 0.1% deficit. Maximum payout is $290 per hectare if the moisture is 27.6%. So that's the lowest. So essentially what this describes here is this is the policy. This is everything there that's needed to figure out. I could very quickly, either on a sheet of paper or Excel, figure out what my payments would be in terms of my risk. Now, the other thing, and this is what I find to be probably the most exciting, is it gives me, in this chart, it gives me exactly what my moisture was for the last, in this case, it's from 2000 to 20. So this is the last 20 years, basically analyzing my risk profile for moisture. So I can tell you that over that past 20 years, how many of my years were above average moisture, how many were below, and how many would have been deficit years based on these 15% worst case. So really, this is amazing risk management material. So I can look at, if this happens to be soil moisture, if I looked at heat units, if I looked at rainfall deficits, excess rainfall, whatever, I could look at these types of things and see, all right, what's my risk? And, not just for the insurance side, and yes, I could buy insurance to cover my risk, so the risk transfer, but I could also look at things like, well, if I have a lot of years with excess moisture, maybe I should look at, remediating that risk or, mitigating it in some way, drainage, those types of things. So I think this is just, it's just an example, but I think there's some really good information here. And these products, there's more of them coming to North America, to the prairies. Here's a few examples. One that I worked on a fair bit actually is canola heat blast protection. It's offered by a couple of agencies now. Farmers Edge does, as well as GARS. Terry mentioned GARS earlier. And one of the things with that one is it's basically, well, GARS and the Syngenta AgriClimb product, those are both what are called embedded or bundled. So basically, if you buy the products, In this case, it's Corteva or the Syngenta products, you get embedded bundled insurance. So it's included in there. So it's sort of a little bit of extra coverage risk management when you try new products. So there's those ones in the private side or commercial products, and then provincially, SAS Crop Insurance has quite an extensive parametric program with both their they're weather-based, so they have a forage insurance, corn rainfall program, and a corn heat unit program. In Alberta, AFSC also has moisture deficit insurance based on the weather stations, as well as a satellite yield insurance for pasture based on NDVI. So the vegetation intensity. And then in Ontario, AgriCorp has one as well for their forage rainfall. To my knowledge, Manitoba does not have one for through the provincial, through MASC. So if anybody knows differently, tell me, but doesn't seem to be anything. So just to finish off and to cover some of the benefits, I've talked about some of these, but the benefits to parametric insurance, well, the certainty. The claims are automatically triggered, like I showed there. If the parameter is triggered, there's a claim. It can be almost instant. The other thing is the insured knows how much they'll receive once a certain condition is met. You know exactly what your payout will be, so there's no ambiguity. There's no question of, well, am I covered or not? The speed is impressive. Sometimes payments can be made in days or weeks. It's quite cost efficient. If you look at the circles on the right, traditional insurance versus parametric insurance, the risk doesn't change between the two. The costs are traditionally much higher with traditional insurance because of the overhead, the adjusters, versus parametric, where the costs are pretty low. That uncertainty is pretty high with traditional versus parametric. So what it ends up being is generally your premium, your cost of parametric insurance, and this is what the farmer pays, can be much lower just because of those differences in costs and uncertainty. So one of the real advantages. And it's safe. The data sources are independent, so there's very little potential for fraud. And I mentioned adverse selection, moral hazard at the start. Basically, the insured receives the same payment regardless of action. So if I'm insured and my neighbor's not insured, there's really no, we would both have the same incentives, the same economic incentives to manage our crop the same. So there's none of that perceived moral hazard of, well, I'm insured, so I don't have to try as hard. I don't have to, I can be riskier, that type of thing. So really in summary, parametric insurance could be an effective tool to complement the existing agricultural risk management strategies, not replace it, but it's definitely a good complement. So with that, I thank you. Hopefully I've not gone too much over time, John, Tammy, but I will leave it there.
No, that was very good. Thank you very much.